Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is OLLI's Bargain Outlet. We'll discuss should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest and author of the Options Playbook. All right, so the markets are struggling to try to stay positive today. And we see the NASDAQ actually leading the way a little bit. The SPX is down a little, the NASDAQ is up a little. So we're going to take a quick peek at the S&P 500 index chart. There's really not much to show you except for the fact that it is just ugly. We look at the big downturn. One of the things that you can highlight over the last few days is right around the 3,900. A lot of people were hoping that that level would hold in the S&P 500 index, and it didn't. Not only did it not hold, it broke through it in a large fashion to the downside. We're below the 200, the 20, the 50-day moving average. So the charts are really looking ugly. We do have a Fed meeting this week, and now the question is the Fed actually going to consider a 75 basis point rate hike? There are some analysts that are saying that that is possible. And then the bigger question would be, would that be good for the markets? If we did get a 75 basis point rate hike in the marketplace, some people feel like we might get a little bit of a dip on the initial news, but that the markets might actually take that as a positive in that the Fed needs to act, and it's appearing that they may need to act quicker or sooner rather than later, according to the CPI number that we received last week, which really created this big drop in the S&P 500 index, a little bit of a rise up in the VIX index. And let's go back and actually look at the VIX watch list. Now, I've been bringing this up and drawing this attention to this for some time here on the Stock Play of the Day. But we see the VIX today down a little bit, had a fairly big run up yesterday, but we see it down 1. That's about 3%. It's trading right around 33. Kind of surprised to see it down hardly anything at all, honestly. We see the SPX right now down a little bit. We can also see the VIX down a little bit. But as far as the actual volatility of the S&P 500 index, that volatility has been higher than what the VIX has been implying over the last month. So our actual volatility of the marketplace, 2 to 3% swings, it seems like on most days in the S&P 500 index, would imply a VIX that could trade as high as 40 to 45% as far as a level of the VIX. Almost like that is, like the VIX is underpricing volatility in what's going on in the marketplace. Not quite sure why that would be, but also interesting to note, not only is the VIX index kind of a little befuddling, which is a term that I've been using a lot lately relative to the VIX. If we look at the VVIX, so I'm going to highlight the VVIX on my chart and look at what happened with the VVIX. We came all the way down to the 90 level. Now, what is the VVIX? I should probably let some of the people out there, I'm sure, do not know of the VVIX, but it's the volatility of the volatility index. In other words, it is based off of the options, the 30-day options in the actual that trade under the ticker symbol VIX. And so it's going to be much higher than the VIX because the VIX is obviously a very volatile index. And so are the option contracts. There's a lot of juice in those option contracts. So to see that come down to the lowest level since we had the big downturn that was caused by the pandemic. As a matter of fact, if I scroll back a little bit on this, right now we have like a week or a daily chart, and we go all the way back to prior to the pandemic. We go back to 2020. You see, ever since August, this level just really hasn't been reached. The markets were doing very well prior to the pandemic, and we see the VVIX actually trading right around that 90% level. Now let's fast forward to just last week, and we saw that the volatility index, the VVIX, the VIX of the VIX, actually come down and touch the 90 level. I still think it's at a fairly low level along with the VIX relative to what's going on in the marketplace. And I say this because, first of all, we do have a Fed meeting this week. There is now a little bit, even though the Fed has been very, well, what's the word? They've definitely said that they're going to have a 50-point rate, basis rate hike, but they've been now, it's been implying that it might be a 75-point basis rate hike in the Fed funds rate. So with that being said, the VIX has came up a little bit on the downturn, but we're still not seeing that huge spike up in the VIX up above the 40 level. And I'm going to add the VIX to the chart right now, which kind of shows you, I have the 40 level highlighted, where you could maybe say, well, okay, now the marketplace is finally bottoming out, and we can get that capitulation where all these sellers get shaken out of the marketplace. And I think we need that. I think we need to have that type of movement to the downside. We're having slow and steady drawdowns, 2, 3, 4%. We had the most volatility in the actual SPX in a while last week, and we still didn't have the VIX actually just come along with it. 32% implied volatility is still below what the actual volatility has been in the marketplace. Okay, so I think that's something worth noting. The other thing that kind of implies that maybe the Fed needs to act a little quicker, and also inflation is a scary thing, is to see the 10-year interest rate be at about 34% or 3.4% right now. And I'm focusing on the TNX, which is the index that tracks the 10-year yield. You just move the decimal over 1 point and you get the interest rate, 3.4%. And we also had the yield curve invert. The 2-year and the 10-year inverted for a little bit. We also saw a big jump up in the 5-year. So recessionary concerns have arisen once again by a lot of the analysts, and a lot of times one of the biggest things that a lot of people that are looking at recession, at the possibility of recession, look for is an inverted yield curve between the 2-year yield and the 10-year on the treasuries. Okay, so more nervousness this week than last week. Fed is meeting, still looking like at least a 50%, 50 basis point hike in the Fed rates. Maybe 75, put a little shock in the marketplace. I personally would like to see that and see a little bit higher, the Fed be a little bit more aggressive, get it over with. Some people have even called for a 100% basis point interest rate hike, and just do the shock to the market and get done what they need to get done. So with that said, recently in the news, inventories about a lot of the major retailers have been making headlines left and right. One of the biggest retailers that was in the news was Target recently. Target came out and said that they've had issues with inventory. They were worried about supply chain concerns, and they still are, but they went ahead and bought a lot of big ticket items. One of the big problems with the big ticket items is that all of a sudden housing demand is decreasing and they are oversupplied in a lot of these items. Well, OLLI's Bargain Outlet is a benefactor of any of these big ticket items and inventory concerns. They are a bargain outlet. They have a lot of cash on hand. And I know them fairly well because they have a real big presence in the South. And right now we're in Charlotte, North Carolina, and there are quite a few OLLI's bargain outlets around this area. So they have a lot of cash, and when there's excess inventory, a lot of the bigger retailers know that they can go to OLLI's and they can get rid of that inventory, obviously at a very discounted rate, and then OLLI's benefits from marking it down and selling it. So if you look at the chart for Ollies, and I'm going to run over to the stock chart right now. Oh, 1 second. There we are. And if you look at it, with the market being down, the exact opposite of what happened to the S&P 500 index, we actually had a fairly strong move up in Ollies. As a matter of fact, we just broke through the 200-day moving average on the upside. It looks like it's dancing around that number right now. So no chart necessarily looks great. I think a lot of this run up in Ollies had a little bit to do with the news, with the inventory news from a lot of the bigger retailers. So, today our title was Good Stocks Cheap, which is Ollie's tagline. They actually usually say good stuff cheap. So we're saying, are there any out there? I don't necessarily know that answer. And I'm struggling to try to find stocks. If you want to try to be bullish on them, you can obviously buy some puts on indexes. As a matter of fact, we've seen a lot of large put buying in the S&P 500 index, the SPY ETF that tracks it, the IWM. There's been some large put buying that has happened recently, and it had a lot to do with the CPI news that came out last week. Obviously, the markets were down. A lot of times you'll have a tendency to see more put buying when you see a big gap down in the markets like we saw in the S&P 500 index last week. Okay, so with all that said, one of my biggest concerns about Ollies, and I'm going to run to the option chains right now, is that there is not a lot of volume in the option contracts. This might be your first time ever hearing of the company, actually. And a lot of times on the stock play of the day, we talk about a lot of the mega cap stocks, a lot of the high volume stocks. And that's mainly because if you're going to be trading options, you want the marketplace to be liquid, because the more liquid that underlying stock is, the better the options will be, mainly because there's so many choices when you're trading options. And I'm going to highlight the fact that one of my top 10 mistakes in a white paper that I wrote a while back that's been republished on the ally.com/doitright website is trading illiquid options. When you're first starting trading, a lot of people chase after the one particular stock, and if they're illiquid options, it's really hard to trade them. So I'm going to take this opportunity to talk about how I might trade illiquid stock. And I don't do it very often, but I do also think that there's a lesson to be learned here. So I'm going to highlight the blog that looks at the top 10 mistakes. And here's the blog inside the ally.com/doitright community. And in here, if I scroll down a little bit, it says right here, mistake number 5, trading illiquid options. If you click on it, it will actually take you down to mistake number 5 and talk a bit about liquidity and some of the concerns about trading illiquid options. Now, if I'm doing this and I'm thinking about Ollies, I would actually think about maybe using the way the marketplace is, planning on buying 100 shares of stock. So we haven't looked at a cash secured put in some time, but the conditions, and that's what stock play of the day is all about, and the options playbook, the conditions are right to think about using options if you'd like to buy the stocks. And I'll highlight some of those conditions when we get back over to the chains. So if I go to the Ally Invest option chains, you will see that always there's right now it's actually up. Market, the SPX is down. We do got the NASDAQ up a little bit, but right now we see Ollies is up $1. That's about almost 2% on the market. That's a good move considering what else is going on in the marketplace. And you also seen the move just recently. But one of the things I like about Ollies is that there's not weekly expirations. There's only the quote unquote normal monthly expiration, which means that the option contracts are going to expire on the 3rd Friday of the month. Now, I draw your attention to that because this is the way it used to be on most underlyings. They didn't have 1 week option contracts, and they didn't have 1 point strikes. They didn't have all of this, and it was mainly because the computing systems weren't available to actually quote that many strikes and that many expirations on a lot of these underlyings. The power just wasn't there. So it limited the strikes that were available on a lot of these stocks. Now, because there are less strikes, it makes it more feasible to try to get to work a trade, because if you have an option contract that expires every single week, some of the volume is going to go to those weeklies, some of it's going to go to the monthlies, and it's going to make it harder to trade all options in general on that underlying. Now, with OLLIs, we're going to look at the July 15th expiration. And one of the things also that I like about this underlying stock for the strategy that we're going to use is that the implied volatility is pretty high. We see the at-the-money implied volatility for that 31-day expiration, July 15th, is trading right at around 60% implied volatility. So that means there's a lot of juice in these option contracts, and that leads me to want to sell something, right, as far as options are concerned. So the strategy that we're going to look at today, and I'm going to pull it up here in the options playbook, is the short put spread. So we're going to sell some premium. And then also we're going to take this as a way to think about, well, in this marketplace, I don't want to sell a put just to buy the stock outright. Why? Recessionary concerns. The market is not looking good fundamentally. It's hard to think about buying almost anything in this marketplace right now. So I'm going to buy some protection. I'm going to sell a put saying that if the market did come down, I'm willing to buy it. But if the market does go up, well, all right, I'm going to receive the net credit and I can make the premium from selling that option contract. But I'm getting a lot of premium because markets are a little volatile, even though I think they should be more volatile as far as the VIX is concerned. But with that said, we get a little bit of volatility, so we get a little bit of premium, and we're going to take some of that premium and we're going to buy some protection. So we're selling strike B here. The stock would be up in this range on our profit and loss graph. Here's the stock price at expiration. Strike B brings in all the risk. You're selling a put saying you're willing to buy the stock at that price. You're taking some of that premium then, and you're going down and you're buying strike A. You're buying the lower price put. Now, if the stock does come down to strike B, well, you can say, well, go ahead and put it to me. I'll take it. Say it's somewhere in between strike A and strike B. Consider maybe buying 100 shares of that underlying stock. And that's the way that I would really approach this strategy. And it has a little bit to do with liquidity and stuff like that. But if I'm trying to bottom pick a couple of these stocks that I think may do well in the short term based off of the conditions, OLLI is a lower price stock. You can $55, or well, it's $54 right now. You'd be buying the stock at $50 based off of our strategy. So you're looking at $5,000 to buy 100 shares of that stock. So it's feasible if the market did come down to actually purchase the underlying stock. And then if it goes up, you're going to get a decent amount of premium. Why? Because we have some high implied volatility. So looking at the actual strategy inside the Ally Invest option chains, here's what we're going to look at doing. This is going to be the official paper trade for this week. We see the stock trading at 54.19. With the stock at 54.19, we're going to sell the 50 strike put. Now, do the math here. 4 points on a $5 stock. Obviously, the math is fairly simple. 5 points would be 10%, so you're looking at around 9%. So you're saying if the market comes down 9%, I would be willing to buy 100 shares of stock at that strike price of 50. But just in case it continues on down and it goes down 20% or more, 19% if you want to be a little bit more accurate, we're looking at, I don't want to own the stock below 45. So over the next 31 days, if the stock comes down, goes below 45 in this instance, well, now I can take the stock that was put to me at 50 and I can sell it on the marketplace via my long put at 45. So the risk here is 5 points. We're going to bring in a net credit of 113 to the account. But now I'm going to highlight the bid-ask spread. Like the net bid and the net ask is 95 cents by 130. So this is a fairly wide market for a spread. but we're doing a spread. And if I'm trading illiquid stocks, I usually want to do some type of spread because you're giving the market maker a buy and a sell, and you're more than likely going to be trading with the market maker because the volumes just aren't there. And market makers like that. Sometimes they may give you a little bit better fill because you're giving them both sides of the market, the buy and the sell. So in this instance, it's at 113. So my total benefit here, my maximum gain that I can make here would be 113 times 100 for every 1-by-1 spread, or $113 less commission. And then my risk would be $5 minus 113 on the downside. So the most that the spread can trade for is $5, but I do get this premium that I save by when I initially said do the trade. So I will have a margin requirement of that $5. Now, if you want to buy the stock, obviously you're going to have to need the cash. You're going to have the cash in there to be able to do it. So ideally, you would like to have $5,000 to be able to buy the stock at 50 if it gets put to you. As a matter of fact, your cost basis would be a little less, right? It would be 50 minus the premium received, or 50 minus 113 in that instance. So let's put it in the right rail and make it the official paper trade. And if you have any questions while I'm doing this, please put them in the chat box. I'm happy to address them here in a few minutes. So we want to make this an open outcry marketplace as far as stock play of the day is concerned. So if you're attending it live, it's wonderful to get some questions and have a little banter between myself and the listeners. Okay, so we're going to go at 110. We're looking to sell the July 15 50 strike put, buy that same expiration 45 strike put. Net credit, well, it looks like it says 108. We'll keep it at right at 110. That'll be the price for this week for this screen. We'll take a screenshot right at that price. That means we're going to bring in $110 less commission for every 1-by-1 spread that we put on. And if I scroll down and I actually look at the profit and loss calculator inside the Ally Invest option chains, you see that this is where the market is at, right around 54. If the market comes down to 50, that's where my risk kicks in. From 50 to 45, that's my maximum loss that I could have. From that beyond, well, I can't lose anymore. That's the maximum I could lose at expiration. On the way up, I'm hoping the market goes up and that I can receive that $1. And once again, if I'm correct on my forecast, and I do think the market would go up in this instance, the options expire worthless. So I have to work the trade to get into the position, but on the way out, if the options expire worthless, I don't have to worry about liquidity. Or if the market is going up and I want to close it, maybe I try to close it for 10 cents or 15 cents. I can, as options get cheaper and cheaper, bid-ask spreads have a tendency to tighten. So I would maybe consider buying this back at 10 cents or 15 cents if everything worked out. Now, on the downside though, if the market is moving hard against you, this is where the liquidity issues can happen. So you got to be prepared that you could lose the maximum on this trade just because you're struggling to get out, and you can work the order to get in and say, well, I'm going to work it for 110 in our instance, and if I don't get a fill, I'll watch it for 15 minutes or so. And if I don't get that trade executed in that instance, well, you know what? I'll just let this opportunity go. I can't trade somewhere closer to the midpoint on that spread. Now, on the way down, markets go down. You got to keep in mind that you are trading illiquid options, and sometimes it makes it harder to actually close out a position and say, I sell this for 110. I don't want to lose any more than the maximum. My goal would be not to lose any more than the maximum that I could make on the trade. So if it's trading for 220, which is double the net premium received, well, maybe I want to think about getting out of the trade. And you try to work the order and try to get out of it, do the best that you can on that instance. There's no good solution when you're trying to get out of a trade that's gone against you when there are illiquid options. All right, so if you have any questions, please put them in the chat box and we'll try to address them. So the moral to today's show is that, all right, we're looking at stocks in a very tough environment. We have some implied volatility. We have some juiced up option contracts. on a stock that is trading a little bit illiquid. So what was our solution? We went out and did a short put spread, tried to sell some of that premium, and we are a good 10%, well, 9% below the marketplaces where we could be put the stock. Then if we are correct on our forecast and it goes up, one of the things that's nice about a short put spread or even a short call spread, if you want to get bearish on the marketplace, is that if the options expire worthless, we don't have to pay commissions to get out of the trade, and we don't have to deal with bid-ask spreads, more importantly. So if I was considering buying a stock like OLLI's, this is how I would approach it in this type of environment. And that's what Options Playbook is all about. We have 40 different strategies, and that's what we try to address here on the stock play of the day. All right, I see a few questions that are in here. Let's look at this. So Joel says, do you think big tech sector is due for even more correction, or has that mostly been priced in already? Thinking Amazon, Google, Microsoft, Apple. Tech is tough right now. It does seem like there's some bargains. Amazon obviously went through a 20-for-1 stock split recently, and we talked about it a lot on the stock play of the day. We actually looked at a long call spread, which actually played out fine in the scenario, but since then, even the stock split has not really helped Amazon get positive in this marketplace. Matter of fact, we're below where the price was after the split. So even though splits have nothing to do with the company, it usually has a little bit of a positive effect, and it did give a little bit of a bump in Amazon for the short term. Google's going to be splitting. We'll be talking about Google on the stock play of the day too, and that's going to be happening in July. So yeah, it's really hard to try to pick a bottom in some of these mega cap stocks. My suggestion, if I am trading these things and trying to pick bottoms, is to dollar cost average into it. Don't put all your capital in right away. Buy it in chunks and maybe think about doing options. So a couple of the trades that we talked about, one of them was in Zoom recently in the stock play of the day to try to address your concerns, is we looked at, we called it a fear of missing out. We had a fairly volatile underlying Zoom communication, ZM was the symbol, and we did a long call spread saying that in the short term, I might look for a little bit of a pop in this underlying stock. I want to participate, but I don't want all the risk of owning the stock outright. This is one way that I could participate, limit my risk, and still get some upside just in case we do get that pop right away. And if that all works out, well, then I can go on out and buy the stock. Maybe I feel a little bit more comfortable about the marketplace after we get a few good solid up days in that underlying stock. So picking the bottom, that's not plausible for me to do. I can't, as a matter of fact, we're not really here to make recommendations on things like that. But I want to give you some things to think about and how I will use options in this marketplace to try to participate if you're trying to bottom pick stocks like Google, Amazon, Microsoft, and Apple. All right. Jim is asking, how is the risk set at 45 if the stock was put to us at 50? Well, Jim, what we're doing is we're limiting the risk, right? So if the stock gets put to us at 50, let's talk about the actual dynamics of the trade. Let's say we're not buying and selling it and closing the position. If the stock came down to 40, and let's say it went to 40, right? In our trade that we talked about today, our paper trade, you would be put the stock at 50, then you could exercise your right and sell it at 45. So if you went through that whole process, you'd never closed out that position. At expiration, what would happen is you'd buy the stock at 50, it would be put to you, you have that obligation, and then you would go out and exercise your long option contract and sell it at 50. Hence, your risk would be limited to $5. Now, we talked about an alternative to this is a cash secured put, where you just sell the 50 strike put, bring in all the premium. And in this marketplace, I'd rather do a short put spread on a stock that I want to buy as opposed to a cash secured put because of the risk of the marketplace. So I want to limit my risk on the downside. And one of the big benefits is, and this is why we're kind of talking about this stock today. One of the bigger benefits is that there's a lot of volatility. When there's a lot of volatility, there's a lot of premium. We can go 9% below and be able to sell a 5-point wide spread in this underlying stock for $1. That's a lot of premium. That's a good amount that we can receive for doing a 1-by-1 spread. So we got 1.10 is what we're looking to sell it for if we could fill it at the midpoint. That's $110 minus commission. Okay. Glenn says, as interest rates go up, does that imply higher interest payments on government bonds, resulting in even greater government deficit and higher inflation? Yeah, well, Glenn, I mean, I think you summed that up pretty well in the chat box. Not much to add to it. Yeah, you will have, it will cost the government more to run a deficit as interest rates go up. We see the 10-year trading above 3%, quite a bit above 3%. It stayed there for a while, kind of implying that maybe the Fed was going to go lower going into the end of the year than a 50-point basis hike. So I think the 10-year is always important to look at, especially around the Fed meeting. See what the marketplace is thinking the Fed may do. You can always just go to the CME Fed Watch too, and it will give you an idea of the probability based off of the futures contracts where the Fed may come in at. So this week they're expecting a 50 basis point rate hike. I think that they're going to be in that range. There are a few outliers that are thinking maybe a 75 basis point hike may happen. All right, one last question and then we'll call it a day. Well, we got Kyle, and Kyle's a newbie. Could you please explain what what option expire worthless means, especially as OLLI increases in price on the chart? Okay, so I would recommend going to the options playbook, and let me pull it up here. If that question is available for you, I don't see where my playbook is. Ah, there it is. Okay. And if that is a concern, what you want to do is go to the Rookies Corner, and there's a one-page, well, maybe it's an options basic. There's a one-page little summary about cashing out your options. And this will explain in detail what the 3 options are once you get into a position. But an option has an expiration date. And if the options are not in the money, if they are out of the money, which means in a short put situation, it means the market has gone up, the options just expire worthless. And just like anything that you sell I don't care if you sell a car, right? When you sell something, you get cash now. And if you get cash now, you can use that cash. You can do whatever you would like with it. So if the options go up, you get the cash now. The options expire worthless. You don't have to close those positions. That means you can take that money and go and invest in something else. That's simple. All right, everyone. Great questions today. Great group. My name is Brian Overby, Senior Options Analyst here at Ally Invest. Every Tuesday, we do the stock play of the day at noon Eastern time. Please share with your friends if you would like to learn more about these strategies. What we're really trying to do is take strategies that are in the playbook and apply them to certain market conditions on certain underlyings. Click subscribe, ring the bell. You will get all the notifications for the next stock play of the day. Thanks for coming, everyone.